Okay, hi everyone, Daryl here. Okay, so this is lesson 49 in my Investing 101 YouTube playlist. And today we are going to talk about this thing called price earnings growth ratio. Okay, it's actually a follow-up to my last two lessons. Lesson 47, I touched on earnings per share. Then lesson 48, I touched on price to earnings ratio. And today we're going to touch on price earnings growth ratio, or what a lot of people call PEG ratio. Okay, so let's understand that PE ratio has its limitations. If you don't understand what's PE ratio, right, I would advise that you go back to my previous two videos on this YouTube playlist and take a read and take a look at earnings per share and price to earnings ratio. Okay, so PE ratio, right, is calculated by measuring historical earnings. Okay, so investors need forward guidance to make decisions about future pricing. That's why sometimes when you see the stock market, a lot of times the stock market moves not because of what the company has produced in the last financial year or the last quarter, but sometimes when the company gives forward guidance, then you see everything start to move already. Like, how come they are doing so badly last quarter, but the price still go up? Okay, because their forward guidance, sounds very attractive. Okay, and if a company is growing quickly, right, an investor may be comfortable to buy with a higher PE ratio. Okay, so later I will show you guys what I mean by this, and when you calculate PEG ratio, right, then you may understand this better. Okay, it is difficult to tell if the PE is high because of expected future growth or whether the stock is overvalued. So sometimes the PE ratio may be very high, but people still go in and buy. So a good example would be tech stocks. Tech stocks, you tend to see PE ratio rather high, but yet people still are attracted to tech stocks. The main reason is because the growth level of tech stocks is very high. Okay, but if let's say you're in a industry which is quite stagnant, maybe we can just say something like now the airline industry is not doing very well. Okay, then or maybe retail. Like if let's say you go and look at the PE ratio of maybe like some US retailer, I don't know, maybe Macy's or something like that. I don't know whether Macy's still traded. I think Macy's still traded, but if you go and look at some PE ratio or some company like that, or maybe like Nike, it may not be, or Under Armour, may not be as high as the tech company. Okay, but people are still willing to go for the tech company because the expected future growth is actually higher than other companies out there. Okay, so they are expected, they don't mind paying a higher PE ratio, don't mind paying a higher price even though the PE ratio is quite high. Okay, so the price earnings growth ratio, or PEG ratio, right, measures the ratio between the PE ratio and earnings per growth. Okay, this is PE ratio. I just remove the slash so that it doesn't confuse everyone. Okay, so what's the formula for PEG ratio? PEG ratio is simply PE ratio divided by earnings per share growth. Okay, so this earnings per share growth, right, is the projected growth. Okay, so maybe they will come out and say we are projected to grow a certain amount. Okay, so let's put this into a calculation, and then we can understand this better. So example one, right, I mentioned the tech firm. So the existing PE ratio of the tech firm is pretty high. That means 30. Okay, so the price of the stock, right, is quite high because price to earnings is 30 times. Okay, but then you see that they actually projected to grow at 20%. Okay, per annum, annual growth, okay, of 20%. So the PEG, right, is 30 divided by 20 is 1.5. So example 2, right, will be airline firm. So the airline firm, right, existing PE ratio is 15. So price to earnings is 15. Okay, 15 times earnings. The price is 15 times earning. Then the projected growth rate, right, is 15%. So if you see this PEG, right, is 15 divided by 15, right, is 1. Okay, so you can see that even though the tech firm has a higher PE ratio, right, but how come investors tend to gravitate to this tech firm? Okay, because they look at this thing called PEG. So PEG at 1.5 looks more attractive than this airline firm of PEG at 1. Even though the airline firm is so-called cheaper in terms of the existing PE ratio. If you compare PE ratio just to buy, right, some people may be tricked into saying, hey, then I just buy the airline firm because it's so-called cheaper. The price to earnings ratio is a lot less. Okay, so the PEG, right, gives investors an alternative tool when comparing between two companies. all these ratios that I'm giving you, like earnings per share, price to earnings ratio, PEG ratio, right? All these are tools to compare between two companies. But can you use that itself or not? Yes and no. A lot of times you must understand the limitation when it comes to earnings per share growth. Okay, because these are actually forward projections. So if let's say the company releases guidance, right, that is not very accurate, then they say that, oh, we're going to grow so much, like, you know, they tend to blow their trumpet and then try to build a mountain when it's actually a molehill. So they try to push up growth, or like top the company up, okay, for whatever matter. Then then after the PEG doesn't seem to be accurate already. But so what you can do is that you can actually see the company, right, whether their forward guidance is accurate or not. So there are companies whereby the forward guidance are quite accurate, so you can take their word for it. Like maybe if Apple releases a forward guidance, right, then it's pretty accurate. If let's say like maybe some banks, when they issue the forward guidance, right, the bigger ones, or maybe like Microsoft, when they release forward guidance, it is quite accurate. But that's why some people, they are quite wary of maybe investing in the Chinese stock market, because the companies, when they release their forward guidance, right, they are not so forthcoming or truthful. They tend to talk it up a lot more. Okay, so try to see whether certain companies, right, their forward guidance is accurate or not. Then have they always been matching or close to their forward guidance? If they are, then you can use PEG ratio on these companies. Okay, that's why a lot of people say you invest in blue chips, but then blue chips, of course, the growth not so high. But then when you want to invest in those like very growth stocks, okay, then you must understand that they come with very very little history. So it's very hard for you to go and see whether their forward guidance has always been accurate or not. Okay, so there's no one rule fits all, which means that we cannot just use one ratio, right, and then make an investment decision. That's why there's a lot of reading that comes forth with going to the stock market. Okay, just like any asset class. Okay, so you need to know these terms. And that's all from me, and I'll see you in the next video.